Imagine pulling in over $1.4 billion in just 3 months.
Right, yeah.
You are actually moving more physical product out the door than you did at this exact same time last year. The factories are humming.
Doing great.
And then you have to look your investors in the eye and admit you somehow managed to lose $53 million doing it.
Wait, the plot twist, yeah.
Welcome to the deep dive, everyone. When you sent us the materials for today's custom deep dive, so that's Huntsman Corporation's first quarter 2026 earnings press release and their April 30th investor presentation, you probably noticed that massive sticker shock right on page 1.
Oh, absolutely. I mean, it just jumps right off the balance sheet. And it's a fascinating setup, really, because reading chemical companies' quarterly earnings might sound, a bit dry on the surface.
A little like an audio textbook.
Exactly. But what we are actually looking at here is basically a real-time thriller. It's this live documentation of how a geopolitical shockwave just instantly ripples through the global economy, completely upends the energy markets, and, forces this multi-billion-dollar heavyweight to scramble just to protect its own survival.
Right, and just to ground this for you listening, Huntsman is not some small niche operation.
Not at all.
They are a massive, globally diversified chemical manufacturer. I mean, the components they make are literally the invisible building blocks of the modern world.
Yeah, we're talking about the insulation in your walls, structural adhesives in airplanes.
The foams in your car seats.
Exactly.
So we aren't just doing a postmortem on one company's accounting here. We're using these documents as a diagnostic tool, like a pulse check on global manufacturing, the construction industry, and aerospace all at once.
Which I think brings us back to that massive headline contradiction you mentioned earlier.
Yeah, let's look at the mechanics of those Q1 numbers. I really want to pull this apart because the top line illusion versus the bottom line reality is just staggering to me.
It's wild.
The revenues actually went up. They pulled in $1.42 billion in Q1 of 2026, which is a slight but, very real increase from the $1.41 billion they made in the first quarter of 2025.
So they literally sold more stuff.
Right. But the net loss attributable to the company widened massively. So last year, they reported a $5 million loss for the quarter. This year, $53 million.
What?
It feels like, I was thinking about this earlier, it's like an airline that manages to sell out every single seat on a cross-country flight, right?
Sure.
But the price of jet fuel spikes so high while they are in the air that they actually lose tens of thousands of dollars just by flying the plane.
That airline analogy actually captures the physical reality perfectly. I mean, the volume of business is clearly there.
Yeah.
But the fundamental cost of executing that business has just completely detached from the revenue.
Yeah.
But, you really have to look deeper into how corporate finance categorizes a quote-unquote loss.
Well, I'm looking at their own presentation, and this is where I get incredibly tripped up. Because they report a $53 million net loss, but like 2 paragraphs down, they highlight an adjusted EBITDA of $73 million.
Right.
And they even point out that this $73 million is $1 million higher than what they reported last year.
Yeah, it sounds contradictory.
So explain the math to me. How do you lose $53 million but also claim your underlying earnings actually improved?
Yeah, to understand that, we have to strip away the accounting fictions. So EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Right, the classic corporate metric.
Exactly. A raw net loss, that negative $53 million, it's a blunt instrument. It includes massive one-time restructuring costs, which we will definitely get to later.
Oh, yeah, we will.
It includes complicated tax impacts. And crucially, it includes non-cash depreciation.
Meaning like the on-paper value of their factories going down over time?
Exactly. It's the opposite of cash flying out the door today.
Yeah.
Depreciation is just an accounting acknowledgement that a chemical plant gets older every year. It doesn't mean Huntsman wrote a $20 million check to someone this morning for getting older.
Makes sense.
So when they calculate adjusted EBITDA, they are stripping all of that noise out.
Yeah.
They are saying to the market, hey, if you ignore the taxes, the factory depreciation, and the massive one-time severance checks we just wrote.
Right, if you look at the actual business.
Exactly. If you solely look at our core engine, the act of making a chemical and selling it to a customer, that core engine generated $73 million in profit. So the operational business is actually holding steady.
Okay, so the core engine is running, but that engine is still dealing with a massive spike in raw material costs, which I guess brings us to the actual physical trigger of this entire situation.
Yeah.
Because the transition from the financial result to the real world cause in these documents is really dramatic.
It all hinges on a very specific timeline laid out by the CEO, Peter Huntsman. He notes that the first 2 months of the quarters, so January and February of 2026, were progressing largely as expected. They were actually seeing some year-on-year volume improvements in their core markets. The supply chains were normalizing. Everything was fine.
And then we hit March.
Yeah. March changes the entire trajectory of the year. The onset of the war in the Middle East introduced what he understatedly calls significant volatility.
Right. Volatility.
Let's talk about the mechanics of that volatility, actually, because a war in the Middle East doesn't just make things generically expensive.
No, it's very specific.
The documents point to very specific feedstock costs spiking. Benzene and, crucially, European natural gas. Why is natural gas the linchpin here?
So European chemical manufacturing relies on natural gas in two distinct, really critical ways. First, it is the sheer thermal power source required to run these massive industrial furnaces.
Okay, so just keeping the lights on and the heat up.
You need immense heat to crack molecules and create polymers. But second, natural gas and its derivatives are often the literal molecular feedstock.
Wait, like the actual ingredients? Yes, the raw ingredients for the chemicals themselves. So when a geopolitical shock hits the Middle East, it threatens global liquid natural gas shipments.
Oh, I see.
And the European energy benchmarks instantly spike in panic. For a company like Huntsman, their power bill and their raw material bill basically tumble simultaneously.
Wow. Which, of course, forces their hand. The presentation shows their immediate reaction was basically a blunt force defense mechanism.
Yeah, aggressive global price increases across all products and regions.
They just passed the pain down the line to protect their margins.
They applied a tourniquet. Honestly, it was the only way to stop the bleeding.
But I don't buy that it's just that simple.
What do you mean?
I mean, if my supplier suddenly jacks up my prices by 15% overnight because their gas bill went up, my first instinct as a buyer is to just hang up the phone and call their competitor.
Right.
So how does a company execute a worldwide price hike without completely detonating its own sales volume?
Well, it becomes a brutal industry-wide game of chicken. You have to remember the nature of these materials. These aren't discretionary consumer goods, you know?
Like, you can't just skip buying them.
Exactly. A construction firm can't build a high-rise without insulation. An automaker can't assemble a dashboard without polyurethane. These are essential foundational components.
Right.
And when European natural gas spikes, it doesn't just hit Huntsman's facilities. It hits every single chemical manufacturer in the region.
Ah, so the buyer can't run across the street for a cheaper deal because the competitor across the street is getting crushed by the exact same gas prices.
Precisely. The entire floor of the market rises at once. Huntsman's ability to actually get their customers to pay those higher prices is the ultimate test of their pricing power.
Yeah.
And the data point that truly stands out in this Q1 report is that despite forcing those price hikes onto their buyers, their overall sales volumes didn't collapse.
That's crazy.
In fact, if you exclude byproducts, their overall sales volume actually grew by 1%.
The market just absorbed the blow and kept buying.
It demonstrates incredible inelasticity of demand. The world still needs to manufacture physical goods, even when the underlying chemicals suddenly cost a premium.
Okay, so raising prices globally was their blunt force weapon to defend those margins. But as you dig deeper into the breakdown of the company, it becomes pretty obvious that this weapon didn't work equally everywhere.
No, definitely not.
You can see this massive divide when you look at what happened to their bulk chemicals versus their highly engineered products. The earnings summary breaks them down into three main divisions.
And it serves as a perfect case study in why industrial titans diversify their portfolios.
Yeah, let's start with polyurethanes, which is by far their biggest revenue engine. This division alone brought in $923 million.
Massive.
And surprisingly, the physical volume of product they shipped was up 4% globally. They cite strong growth in the Americas and Europe, plus a healthy boost from equity income via a Chinese joint venture. So the product is moving.
The product is definitely moving, but the profitability tells a completely different story.
Right. Because despite shipping 4% more volume, Their adjusted EBITDA for polyurethanes actually dropped 7% year over year.
Yeah.
The documents specifically blame lower average selling prices driven by competitive dynamics while simultaneously fighting those rising raw material costs. So they are pushing more material out the door, but making less money on every single barrel.
Consider the market dynamics of bulk polyurethanes, right? A large portion of this goes into housing construction, bedding, furniture.
Everyday stuff.
Exactly. These are highly competitive, somewhat commoditized markets. Even though Huntsman tried to raise prices globally, the sheer competitive pressure in the bulk sector meant they couldn't push prices high enough or fast enough to fully offset that March gas spike.
So their margins just got squeezed in the middle.
Exactly. Squeeze tight.
Then you turn to the second division, performance products, and this is clearly the struggling child of the quarter.
Yeah, it was a rough one.
Revenue dropped 11%, down to $228 million. Their adjusted EBITDA dropped 13%. And the presentation points to some heavy operational disruptions, not just market forces.
The underlying mechanics of that drop are crucial to understand. It wasn't just that people stopped buying. It was that Huntsman physically struggled to produce and deliver.
Oh, really?
Yeah, the report explicitly highlights supply chain disruptions throughout March at their consolidated joint venture in Saudi Arabia.
Okay, walk me through that. How does a geopolitical shock physically disrupt a Saudi supply chain to the point that it tanks a whole division's earnings?
Well, a consolidated joint venture means Huntsman shares both the financial risk and the operational logistics.
Okay.
So when conflict erupts in the Middle East, maritime shipping lanes become compromised. Insurance premiums for cargo ships skyrocket, or vessels simply refuse to dock altogether.
Wow, so the boats just stop coming.
Right. And if your specialized performance chemicals are sitting in a storage tank in Saudi Arabia and the ships stop arriving to pick them up, your inventory backs up.
Yeah, nowhere for it to go.
And when inventory backs up to maximum capacity, you have to physically throttle down or turn off the chemical plant because there is literally nowhere to put the new product. You stall the entire revenue machine.
Ouch. And it wasn't just Saudi Arabia, right?
All right.
They also highlight the closure of a maleic anhydride facility in Moers, Germany.
Yeah, the Moers plant.
For those of us who don't have a chemistry degree, what is maleic anhydride, and why does closing one plant in Germany hurt this division's numbers so badly?
So maleic anhydride is a vital foundational chemical. It is the binding agent used to create fiberglass composites for boat hulls, synthetic resins, even agricultural chemicals.
Cut it.
Losing a primary production facility means you are permanently stripping revenue capacity out of the division. You combine the lost capacity from the German plant closure with that maritime gridlock in Saudi Arabia.
And you get a perfect operational storm for performance products.
Precisely.
But then you turn the page to the third division, advanced materials.
My favorite part.
This is where the narrative completely flips. Revenue hit $279 million, which is a 12% increase. But the jaw-dropper is the profitability.
Yeah.
Their adjusted EBITDA for advanced materials soared by 25% year over year. How is one division seeing a 25% profit explosion while the other two are getting battered by the exact same global gas price hikes?
You have to look at the end buyer. Advanced Materials is not selling bulk insulation foam or basic resins.
Right.
They are engineering highly specialized polymers for the aerospace industry, the power grid sector, high-end automotive manufacturing. We are talking about the structural adhesives that literally hold commercial airplane wings together.
Okay, so the stakes are infinitely higher than a polyurethane mattress foam.
Immeasurably higher. And because the materials are so critical, highly engineered, and rigorously tested for safety, the buyer's sensitivity to price changes is completely different.
Ah, I see where this is going.
Yeah. If you are a major aerospace manufacturer building a $100 million jet, and Huntsman tells you the custom composite for the fuselage just went up 15% because of global gas prices, you don't cancel the jet.
You just pay the premium.
You pay the premium. Aerospace demand is booming right now, and the products are so specialized that Huntsman has incredible pricing leverage.
It really proves the value of the portfolio. The massive margins in aerospace are effectively buffering the company against all the bleeding in the bulk chemical markets.
It is honestly the only reason their overall operational engine is still functioning so well.
Okay, so we established how they are trying to manage prices and rely on high-margin divisions. But Huntsman can't control wars in the Middle East, and they can't dictate the daily spot price of European natural gas.
They are at the mercy of the market there.
So the conversation in this earnings presentation heavily pivots to the one variable they absolutely can control, their own internal footprint.
And they are being ruthlessly aggressive on that front.
They outline what they call a cost realignment plan. They are targeting an annualized run rate benefit, which is basically permanent, baked in yearly savings of about $110 million by the first quarter of 2026.
That's a huge number.
To get there, they are cutting roughly 500 jobs, which they note is already about 90% complete, and they are shutting down facilities all over the global map.
Yeah.
We are talking plant closures in Boisbriand, Kings Lynn, Deggendorf, Dubai, that Moors plant in Germany we just discussed, East Lansing, and Frankfurt.
It is a massive contraction of their physical and human footprint.
But I am struggling with the math of how you execute this, honestly.
Okay, how so?
The presentation shows Huntsman is spending approximately $80 million in restructuring cash costs just to achieve these permanent savings. Walk me through that. How do you spend $80 million just to turn the lights off and fire people?
Well, shutting down heavy industrial infrastructure is incredibly capital intensive. You don't just lock the gates and walk away.
Right.
You have to safely decommission chemical reactors, which often requires specialized environmental remediation just to clean the site.
Oh, that makes sense.
You have to break long-term commercial leases. You have to pay out massive severance packages to highly specialized engineers and plant operators. You are essentially paying a massive upfront penalty to buy your way out of future recurring costs.
Okay, so you are spending $80 million today to ensure you don't bleed $110 million every year going forward.
That is the core logic, yeah. But what is truly revealing is where they are making these cuts.
Where are they?
The documents show that roughly 60% of that $110 million in savings is coming from SG&A, so selling, general and administrative expenses, as well as corporate overhead and R&D. Only 40% is coming from actual plant fixed costs.
Really? Why target the corporate overhead so heavily instead of just closing more factories?
Because in a high feedstock cost environment, having a bloated corporate footprint drains the cash you desperately need just to keep your factory furnaces running. If your margins on bulk chemicals are thinning out, you can't afford a massive layer of middle management or excessive external consultants or, speculative R&D projects that won't yield a commercial product for a decade.
So they aren't just reacting to a bad quarter, they are structurally lowering the floor of what it costs the company to simply exist on a Tuesday.
Exactly. They note that in 2026 alone, they expect to see a $45 million in-year benefit from this optimization. It's a brutal strategy, but mathematically necessary.
It is a deliberate reweighting of the company for a future where high energy costs might just be the permanent baseline.
It's the new reality.
So if we take stock of where they stand, the Q1 damage is assessed, the prices have been aggressively hiked, and the internal engine has been ripped apart and rebuilt to run significantly leaner.
Right.
Where does Huntsman go from here? Because the final piece of this puzzle is their projection for the second quarter of 2026.
And this is where the tone of the earnings presentation shifts from a defensive crouch into a highly confident offensive posture.
The company is projecting a massive, almost staggering step up in profitability. For Q2, they expect their adjusted EBITDA to land somewhere between $100 million and $130 million.
Wow.
Now, keep in mind, we just spent the last 15 minutes breaking down how they fought tooth and nail to achieve $73 million in Q1. They are essentially forecasting that their profits could nearly double in a single quarter.
It is an incredibly bold projection, particularly when you factor in that the geopolitical volatility they cited in March hasn't exactly vanished.
No, not at all. So what are they basing this massive leap on it? Their assumptions for this Q2 outlook seem to rely on three pillars.
Okay.
First, they fully expect those aggressive global price increases to stick, outpacing the raw material costs. Second, they are banking on seasonal volume improvements in the construction markets. The simple fact that commercial and residential building always ramps up when the weather gets warm.
Yep, construction season.
And third, they're relying on that continuous high-margin boom in their aerospace and power grid materials.
Which is doing so well.
Right.
If you are tracking the broader global economy, that Q2 projection is a deeply optimistic signal. Think about the psychology behind that forecast.
How do you mean?
Huntsman is placing a massive public bet on the resilience of the global industrial base. They are betting that construction firms, auto manufacturers, and airlines will simply absorb the newly inflated prices without flinching.
Yeah.
And they are betting that the harsh internal medicine they just took, slashing 500 jobs and closing global facilities, will act as a profit amplifier, turning every dollar of revenue into a wider margin as the year progresses.
It is a high-wire act of corporate management, really.
Totally.
So let's bring this all together for you listening. We started this deep dive with a balance sheet that felt completely disconnected from reality, revenues pushing 1.42 billion, yet a widening net loss of 53 million. We pulled back the curtain to find a war in the Middle East, triggering a massive spike in European natural gas and benzene. We watched Huntsman scramble to deploy a global tourniquet, aggressively hiking prices, while simultaneously executing a ruthless $110 million cost-cutting plan, shuttering plants from Germany to Dubai.
Yeah.
And we ended with a wildly optimistic projection for the rest of the year, heavily anchored by the unbreakable demand for airplane wings and high-end engineering.
It really is a masterclass in how global shockwaves are managed on the ground. But examining their strategy does leave us with a deeply provocative question about the future.
I always appreciate a looming complication. What's the blind spot in their plan?
Well, the entire premise of their Q2 optimism and, honestly, the survival mechanism of the broader chemical industry right now relies on their price increases being seamlessly accepted by the market.
Right. They need the buyers to keep buying.
Exactly. They need those hikes to permanently offset the raw material spikes. But there is a ceiling to economic elasticity. If this geopolitical instability in the Middle East isn't a one-time shock, but rather the new normal for global energy, how long can heavy manufacturers simply pass those continuously rising costs down the supply chain?
Oof, that's a good point.
At what point does the ultimate end buyer, whether that is a regional construction firm trying to buy polyurethane insulation or a massive airline purchasing advanced composite materials, look at the compounding price tag and simply say, we can't afford to build anymore?
That is the multi-billion-dollar question. Will the global supply chain continue to bend and absorb the inflation, or are we slowly pushing it toward the breaking point?
Well, thank you for joining us on this custom deep dive into the hidden mechanics of corporate finance. It just proves that behind every dry quarterly spreadsheet, there is a global supply chain thriller. If you understand the levers being pulled. Keep digging into the why behind the numbers, and we'll get you next time.